We are covering OEX, S&P 100. And what is that? It is this right here. S&P 100 stocks is called OEX. It's called S&P 100 monthly. The bull rally that we have had when we started the financial crisis over here, we put the bottoms in 2009 where we were. And what we do is we take the total reversal high of the calendar year of 2007 to the bottom. That was the reversal distance. The releveraging process with stimuluses all the way up with Q1, 2, and recently QE3 has driven our markets much higher, up to multi-year highs in the current cycle. Between where this particular bear started, where it ended, now it's right back up here. And the bull and bear structure between both sides of the market is that on the way up, this bull over the multi-year, compounded multi-year level is much stronger than what the bear was. Very strong. It went down, but it went all down very rapidly during that financial crisis that we all know about. And then we got down here where bailout America came into play, as we all know. And QE1, QE2 came in right about here. And on the monthly level, we continue to rally up because you could not break below the 20-month moving average. We have all the live coverage, and we went straight up for about a 25% move when QE2 had come into play. Now, QE3 has got us to here. Anticipation levels, worldwide bankers, everyone around the globe printing money. We have tremendous problems around the world right now with U.S. embassies being under attack. You have a major election in the United States of America that is in play. We have an economy that's been very weak, but now we have the Federal Reserve coming out in the FOMC meeting, QE3, and basically open the checkbook. Open the checkbook permanently or indefinitely, the way that they made it sound. So they're going to be printing money faster than anything. Then they're going to be printing money around the other parts of the world. So what's going to happen? We're going to get this massive liquidity. And that's what will drive markets higher in a shorter term, as it's done this calendar 2012 on this date of 9/15/2012. We've been involved in every step of the way. So people that are high net worth and you're looking for risk management scenarios, this would be the place to be. People that want to be market makers, this is going to be the place to be. We are going to tell people that in a shorter term that these names are overbought and there will be a rotation model. We have an extreme bull monthly. We're about to break a 12-year downtrend in this particular index. And the S&P 100 are stocks like Apple, Amazon, American Express is in here. You got all the bellwethers. Caterpillar, Baker Hughes, Bank of America. These are the companies. Got Ford, FCX is even in here. See that? We've covered that one. Google's in here. See? This is the backbone of America right here. JP Morgan's in here. See? MasterCard's in here. We trade that all the time. So this is part of this S&P 100 index. Qualcomm, well, it does well at times. It's semiconductor stock, has chips. There's some defensive names out in here. You got Target in here. This thing has performed well. So these are the kinds of stocks. You got Verizon across the board in here. Walgreens in here. Here's that OXY that we cover in that one sector. That's in here. We already covered that this morning. And that was in that energy sector. Okay? So basically, we are technically, mathematically, from where this particular reversal started on a monthly level to the current closing date of this calendar month so far. This is the month of 9/1 of 2012 now. And we opened at 646 and the high was 676. That was 30 handles, and we had a low of 641 and the close 672. Right up here at this monthly resistance level. Now, I'm going to take the S&P 500, which I put together right here, and this is where the S&P 500 had its high. And what we look at in MTs is that we go to the calendar year high, 1576.09. And we know what that is. That was the reversal side back where the financial crisis started to the very low that shook everyone out of the market was 666.79. And that monthly close ended up being 100 points, which was 797.87. We were right there. And this is where the stimuluses came into play. This is where the leverage up processes came into play. And we bid these markets right back up to where the whole event started. Now, with the Federal Reserve going to have that checkbook that's open, unlimited, you never fight the Fed. However, markets will have trading ranges. They will have bull exhaustions. There will be pullbacks. That's where people are going to buy stocks because they said they're going to keep the interest rates low out until the middle of 2015. That's exactly what they said. So that means that the fund managers, mutual fund managers, hedge fund managers, institutional managers, and the regular retail public have every reason to buy stocks when they come down and hit their support levels. Now, the earnings cycle and the economic cycle is a different component. So let's not confuse the two. Let's keep them separate. And let's focus where the last 4 months have taken us in anticipation of Mario over there in Italy and the lady in Germany. And then we had the German court make their rulings and some amendments. But right now we have people rioting around the world in hatred. For whatever reasons, it's not good. And don't think that it is, because it's not. Now, when we're talking about markets and exchanges, we're talking about the kind of monetary policies that have gotten us here and the next biggest trades in 2013. And we're right in that election part of the year. But this particular part is where a new monthly bull started. And we are these many months right here. We're 3/1 of 2009. And the time cycle's 9/1 of 2012. Now that is the monthly cycle from this monthly low of your new bull that has been reorganized throughout using various financial stimuluses. However, growth will remain at a lower rate. What will drive those fund managers off the side is that they have the Fed behind them in a bigger way than they anticipated. They got a lot more out of that announcement and it shook them. Hey, wow. Well, let me tell you something. Yes, it's a bull from the bear. This was the bear, and the bear right now, when you take a look at the amount of monthly upside versus this time frame, all happened in that calendar year of the financial crisis. But this is where you get the power behind the markets. And it's time for people to understand that markets will go back to overbought and oversold conditions. Yes, the fiscal cliff is out there, sure. But who cares? That's forward looking. Right now, the Federal Reserve made it clear. and the rest of the liquidity around the world will come pumping in at massive levels, which we find in our own view that why would these things happen? Why would everyone be going to this extreme? Why would Mr. Bernanke, in its own logic, monetary-wise, is why would he go to the extremes that he went to? There has to be a reason. So think about that for me if you're just viewing the video. Now, MMTs that are being taught, they're being taught right now that stimuluses work for a period of time, as we all know that they do fail. Like here, they failed. And there are times where things will get shaky and bumpy and they'll fail here. But then they went up higher, and that's how stimuluses work. This was a 2011 correction. They were all up. Boy, they were gung-ho on growth. They didn't get it. And they had a correction that was viable. And the bull, though, was higher here than it was over here. And it already had strength off of the bottom, as it did, and rallies and pulling back. Bull and bear markets are supposed to have directional price movement. When they get overbought, they're simply to reverse, then set up, and then continue their rallies. We are in a different time right now in calendar 2012. This is the system that the U.S. people live under, and then they have the worldwide governments that are also printing money and will go to any extreme at the current level to come to agreements to make it where the whole financial system does not implode. And this is why the bull is strong. And what we're going to look at in a shorter term, there will be trade management structures in time series cycles and seasonality cycles that will also take place looking forward. Let's make that clear. There will be earnings coming in October of 2012. We are at a major level that started many years ago, and it started right back over here in year 2000, where the markets went down in the S&P and it was a big correction. We were here back in 1996 when you had the big breakout, and that was multi-year expansions with multi-year contractions. And then look at here, back in the Bush days, we had the big move up here to where the financial crisis was. But look at the multi-year expansion in our economies that are not working right now. We do not need higher taxes in our economy right now. No. This is the history. This is your market history for you to know. And what happens at times is no one ever thought, ever, that you would come all the way back here to 1996 levels. And look how it imploded. But look at how the expansion did not last. And there was lots of stimuluses that were going on over here. But the financial crisis started. They came back in the systems. They have put the monies in the system. And they have driven the asset valuation higher. However, forward looking in calendar 2013, you will have increased food, what? Food inflation prices. You're going to have energy inflation. You're going to have various components of inflation that will actually hurt the consumer. Even though that we're in a bull trend right now. Doesn't matter. And we've come back up to where the crisis has started. But we know that over time, that expansions, these were growth expansions here. And these were stimuluses and growth expansion here. But look what happened. It imploded. We all know what happened to the housing market. But we know that Mr. Bernanke is going to be buying $40 billion a month in mortgage-backed securities. We do know that. So when we look at the market history and we look at where we're currently at in the environment, we can take a look at the multi-year highs being taken out right across here. And the reason why I have these trend lines drawn here for MMTs, they already know what they mean because we talked about them. But for the people watching the video, this is where the trend channels changed, but this is where the longer period of the 2000 top was, and how we took those tops out in that expansion rally, but how it gave it all back up where it all started. And when things are manipulated, there are consequences. There are consequences to stimuluses. What we see happening forward looking in 2013 is there's a lot of roadblocks, sure. But the Federal Reserve has given that message, hey, you can buy the equity side of the market because you're not going to get a return anywhere else. And if the housing market is supported, just like it back was in, let's say around between that period, 82 and 83, I remember it like yesterday. Mr. Trump was, about to go broke or whatever. But when the real estate market does hit a bottom and the financials come back into play, whether they're stimulated or not, they're still going to have earnings growth. And they're going to have consumer participation within the broader financial system. Therefore, there's a lot to think about, and there's a lot to be excited about, and there's lots of opportunity around the corner. Let me tell you how much opportunity there is. You just keep following stockmarketfunding.com. And right now, we are going into the rest of the trading month starting Monday. It's 9:15, and we're covering these bull and bear trends, and we've already done a good job. And when we came off the bottom in this first diagonal trend line that came right down here from that top or where that reversal started, when we got above here, this is when they were breaking this part of that bear right here once it got up here, and it did, and bam, we got up here. But see, the higher that we got elevated, we were taking that much of that short-term financial crisis bear out of the market with the multi-year and multi-monthly, weekly, monthly, daily, everything involved. Doesn't matter. Is that we're right back up here where the whole fiasco started. I will go into the fact that we are at monthly levels within the rally and the FOMC and everything that's been playing out, and we're going into the election. We have worldwide events that could happen with Iran and Israel. Israel and Iran. What's going to happen there by the end of the month? And why would he make a move at the end of the month? The person that runs Israel there and those folks. And why would that happen before the election? Between Mr. Obama and Mr. Romney, Mr. Ryan and Mr. Vice President that we have right now. They're competing with each other on what they're going to do with these events that are potentially forward-looking, and there is a lot of austerity. However, stimuluses are done differently, but let me tell you that in the short term, when we go from a newborn bull, from original financial crisis bear, we take a look at the bottom date of 3/1 of 2009 to the current level of 9/1 of 2012 at our price target. It hit my price target. I said if we break above, we could hit the 1475 resistance area in the S&P 500. And we did that. And we broke above the 1426 calendar highs because we did. And we did it based on what everyone was anticipating, and that was Mr. Bernanke doing some kind of QE3, but they went way above the limit. And now what I will tell people and MMTs that are in our school is that markets themselves, it's going to always be from where the expansion started in the calendar month to where we are, and it's a time series part. And what is really different forward looking is that mathematically the bull is in charge, and they have every reason to buy the dips. People have underperformed the market. Part of what's going on with that FOMC meeting is to get people to participate in the market. To get people to know that, hey, we're behind you. It's a safe way. It's safe, they're saying again. in their statement. Their statement is telling you, hey, buy, you got to buy now. So now we're going to be looking forward looking. We're going to be looking at the on-balance volume. And we're going to be looking at other key areas within the whole bull side and how bulls trade versus bears. Bears go straight down, bulls go up, and bulls come down. And we called the top right here at this reversal of the calendar 2012. We have the live videos. We did put options. We made a gain, and then we got calls, and we went up, and we made gains here too. We made breakouts here too when they didn't want to break. And we know how the QE2 was, but we're telling people that QE3 will not have the same effect as it did over here in this calendar year. It will not. It will have an effect to keep that money that has been on the sideline for multi-years to work its way over, because there are lots of other things that we will talk about as far as interest rates and other key metrics that work within the broader financial system that play a backbone role in all of this. Those are the kinds of things that you need to learn. And we are going to tell people now that when we look at the S&P 500 here and we take a look over here, this chart right below me, that's that 100 index. This is the backbone of America right here, and it's up at its all-time financial crisis high. Everything was on sale. They went straight down. But look at the pattern here. Look at the two. See, so how do I make the trades? If this S&P 500 was going to work for you, then this would have worked for you, and the SPYs would have worked for you, and lots of other things would have worked for you, and you could have been diversified in your long trade management. Long means to go higher. That's what that means. And how do you get broad-based diversification out of long trade management? And how do you get diversification on reversal management? On reversal management. So how do I know when to sell into these things when they're coming out of their new bull? It's a new bull because it came back to these monthly levels of the 96, 97 expansion where we were selling short up here at these monthly double tops. And the world changed. Technology is quite different over here than it was over here. And how markets respond and how people engage, and what their engagement and activities are in the buy and sell tape on a daily, monthly, weekly, yearly level. So we are right back to major resistance levels that are going to be cautionary, because there are lots of things that could happen, such as wars. And I will tell you another thing. Wars happen. Iran and Israel could come into play by the end of September. And the problem that we're faced with is that short-term disruptions can cause corrections from overbought levels in this multi-year newborn bull. Because the bear was here in 2000. The bear came back in the financial crisis. And you've had 12 years of bear, and we're about to take out a 12-year bear. And in a shorter cycle, on a shorter yearly cycle, we will work with this cycle of this yearly cycle here. We'll break it up into different mathematical components within the reversal where the bear originally started, where it rallied, how it fell, and gave it all back in that, and how we come all the way back up from that financial crisis. This was a big pump and dump expansion right here, like most are. And why do stimuluses always hurt? It's short-term gratification and everyone likes it. Yes, and it's supposed to provide what? Confidence, security, for who? For you. So, listen. What we're telling our people, our MMTs and our students, is that We are about to break a 12-year downtrend, and because of the multi-year downtrend cycle that we have had, is that our economy is really not that much better. Cautionary is cautionary. Now, the reason why we're telling people is that every time that these incidences happen here, we were short the market and same thing, and we gave the warnings to people. And even when we had the pullback here in the 2-month area, we were getting short and telling people, hey, we're going to pull back. It didn't break down. It all started over here in the bottom of the 2011 from that short top, when everyone thought that growth was going to be at 3.5%. Boy, what a rude awakening they got, including Mr. Bernanke, who forecasted it himself at that time. Yes, in this calendar year. Now, what has happened is he's come back and kind of done things that people would say were quite surprising, out of total surprise, meaning that basically opening that checkbook. Now, what's going to end up happening is that there are consequences to everything. I'm not going to go into that right now in the video, but I will go into that as we move through the calendar year and into 2013. It's time for you to think about what Mr. Bernanke has said to you, because he has basically told you, if you keep your money in a CD or various other things that do not give a favorable dollar price yield to your well-being, is that you will buy equities. Now, this is really for the bigger, broader part of Wall Street. Bankers, hedge fund managers, mutual funds, they're going to have to come back. And other institutions that invest in U.S. equities, such as the United States of America corporations and outside of here, is that they're going to have to finally, when those dips come like this, let's say there is a war at the end of the month, and we come back down and test the 20-month moving average in here, and that the S&P has it, but it's still in a bull. So when the bull will pull back again, as we've stated clearly, is that that's where you would look at buying the dips, because Mr. Bernanke's made it clear you will, or you won't make any money. And we will keep interest rates low until the middle of 2015. So, listen, we're here, we're behind you, we're your friends, because if our MMTs, of course, you know, they're part of us, but the people that may be watching this innocently, it gives you a lot to think about. And one thing that I'm going to conclude this with, in these multi-year monthly cycles, multi-years, is that governments create, but guess who benefits? Who do you think benefited? People were invested all the way up. People that make the laws, people that create things. Here, I mean, there are reasons why they had to go down, but somebody benefits. And why is it always that the public is left out of these long, broader moves? Why is it in the calendar of 2012 and down here at the bottom of the austerity package of 2011, why only 11% of the hedge fund community is outperforming the S&P, and the other percent level is underperforming? Because they're, you know, what ends up happening is the amount of uncertainty and fear. Yeah, markets are going higher. It's been one of the most hated rallies this calendar year, when bulls are supposed to enjoy it. And what we're telling people is that you too need to enjoy it, but you're going to have to be trained on how to deal with it. And the reason why we're giving a major update is because we're doing it right in the middle of September. And we're doing it before the end of September, because there's lots of things in the shorter term, even outside of what Ben did, is that you can and will have pullbacks, but people will try to buy those pullbacks. Now, depending on who comes out front in the election, will it be Romney or will it be Obama? That's yet to be determined. But right now, the broader public is looking more on the Obama side than the Romney side. We do know that higher taxes will have a consequence, and you can't tax your way out of uh, high deficits. People won't pay it. They're not working. They have to go back to work. And we have to do things that's going to protect us. Right now, I'm going to conclude this that the S&P 100, the backbone of U.S. stocks here, and the S&P 500, that's our bellwether here of our country here in the United States. Got Target in here. I've already went through lots of our companies in here. They all have bull trends now too. A lot of them. A lot of them had suffered growth contraction because they did. And same thing over here in the S&P 500. These are the top 500. It's a little bit broader. You know, there's 500 versus 100 companies now based on market capitalization and things like that. And beta. And lots of things that the exchange model uses. But we know that some of the names that are out of favor in here will go up higher in prices. I've covered the energy and the commodity related index. I started covering it in the middle of the summer, and I also covered it of what it would look like with Mr. Bernanke and QE3 coming into play. And that was the Deutsche Bank Energy, DXE. We'll be doing the oil services because there are names in here that have been that used to be the all-time bulls. They're in bears. We got a couple in here that we will feature, but we already did the DXE now. And we know which ones that we're going to trade in here now. And we know that OXY is part of that S&P 100 we do. And we know that buying the dips and why that these fund managers will buy over here now. And same thing in NBL. But yes, there will be trade, and same thing in EOG. This is one, and some of these names that we've traded in other bull economies, bull earnings will have to return though. And they will. Because they'll end up making more money if we have problems that I'm talking about. So therefore, as far as the S&P 100 and 500, from the calendar top of the financial crisis to the bottom to the current monthly close of September of 2012, is that you have more of a bull than a bear. And that the bear, as far as the mathematical equation of a bear goes, now let's keep it in the reality. Let's keep it in the context. Is that we mathematically have walked off the bear. And we're at major resistance level. And this will be a video that will be probably broke up in 3-part series. But it will be one that you will remember forward looking for a long time because it's going to become very clear to you. And that is my promise to you, is that you have a way to take a look at these broader markets, what the worldwide financial system is doing, but most importantly, how do I make sense out of it?